Welcome to the Deep Dive. We're the show that takes your sources and pulls out the insights you need to, well, make sense of things.
Hmm.
Have you ever been in one of those business meetings? You hear terms like accruals or maybe depreciation, and suddenly that familiar sort of cloud of confusion just descends.
Oh, absolutely. You're definitely not alone there.
Yeah, it feels like trying to navigate a really busy city with a map, but it's written in a language you don't quite get.
Hmm.
But what if, understanding those numbers wasn't this huge chore, but actually more like a secret weapon for your career?
Hmm.
Okay, let's unpack this. Today we're doing a deep dive into financial intelligence for managers, beyond the numbers.
Mm-hmm.
And this is a really practical guide aimed at empowering us, to move past feeling intimidated and start making genuinely smarter, more impactful business decisions.
Right.
Our mission for this deep dive, it's really to demystify those financial concepts that often seem, well, intimidating. We want to transform them into clear, easy-to-digest explanations, show you how to interpret financial data with intelligence, with context, and importantly, with a healthy dose of critical thinking.
Yeah, exactly.
Because, as our source really drives home, financial literacy isn't just for the accountants tucked away somewhere. It's essential for anyone who wants to be an effective leader.
And it's fascinating how common that feeling is, that overwhelm. So often managers kind of shy away from financial statements just because they look complex, almost like a foreign language.
Right.
Yet ignoring them can directly lead to, well, poor decisions. And those decisions can ripple right through an organization. We tend to think of them as just, accounting numbers, maybe stuff for the scorekeepers. But they are, in fact, the reflection of business reality. They show the actual performance, the critical decisions being made. So this deep dive is really designed specifically to bridge that gap, helping you connect the raw numbers to their real-world impact.
So let's get straight into it then. Why does financial intelligence actually matter so much for you personally, beyond just, say, balancing a budget? Well, understanding these financial numbers, it immediately gives you more credibility,
Yeah.
gives you a surge of confidence, and real influence in those critical business discussions.
Yeah.
Just imagine, you're presenting a new project idea. How much stronger is your argument when you can clearly explain how your proposal impacts the company's cash flow, or its profitability, or maybe its return on investment? It's not just an accountant's job, it's your chance to lead more effectively.
Exactly. Financial intelligence isn't some kind of niche expertise for just a few people. It's really a foundational skill for leadership today. Our source puts it beautifully. Knowledge is most valuable not just when you understand it, but when it's actually applied to make a difference.
All right.
So if you're not engaging with these numbers, you might be missing crucial insights. Insights that could elevate your impact, maybe even reshape your department's strategy. Which, makes me wonder, in what specific areas of your work might you currently be missing chances to influence key decisions or maybe shape strategy just because you're not quite comfortable navigating the numbers?
That's a powerful question, really hits home. Okay, now let's get into the heart of it. The three core financial statements. These aren't just obscure documents to be afraid of. Think of them more like essential diagnostic tools for understanding a company's health.
Good analogy.
First up, we have the income statement, often called the profit and loss or P&L statement. And here's where it gets really interesting because it paints a picture of revenues, expenses, and ultimately profit over a specific period of time. It's like a quarter or a year.
Right, a defined period.
But, and this is crucial, our source highlights this, revenue doesn't always equal cash.
Ah, yes.
Yeah.
Very important.
A company can record a sale, meaning they've earned the right to collect the payment, but they might not have actually received the money in their bank account yet. And what often surprises people is that profits themselves are significantly influenced by specific accounting choices, things like depreciation or accruals. So the really critical question you always need to ask here is, what assumptions, what choices are actually behind these numbers?
And understanding why those accounting choices matter is absolutely key for you as a manager. They aren't just arbitrary rules. They're actually designed to provide a truer picture of a period's economic activity.
Okay.
So let's quickly clarify what we mean. Accruals, for instance. That means we recognize revenue when it's earned, not necessarily when the cash lands in the account.
Right. Earned, not received.
Exactly. So if you finish a big project for a client in December, but you won't actually get paid until February, well, that revenue is accrued, counted in December's income statement. And similarly, expenses are recorded when they're incurred, not always when you actually pay the bill.
Ah.
This gives a more accurate view of how profitable an activity was in that specific period. But you got to remember, it's not the same as the actual cash movement. Depreciation is another big one.
Yeah, that always comes up.
Right. So if your company buys a large asset, say a new machine, it costs $1 million, maybe it'll last 10 years. You don't just record that entire $1 million expense in the year you buy it. That wouldn't make sense for judging that year's performance.
No, it would skew things massively.
Exactly. Instead, you depreciate it. You spread that cost over the 10 years it benefits the company. So you'd maybe expense $100,000 each year on the income statement. These choices, they clearly impact the profit number you see, but they aren't a direct cash outlay each year after the initial purchase.
I see.
Now, if we connect this to the bigger picture, the balance sheet offers a different but just as vital kind of insight. While the income statement covers a period of time,
The balance sheet is a snapshot.
precisely, it gives us a snapshot of a company's financial health at a specific moment in time, like taking a financial photograph on December 31st, say. It's built on that fundamental equation. Assets equal liabilities plus equity.
Right. Assets equal liabilities plus equity.
Got it. And this statement helps us see the difference between short-term assets, things you can quickly turn into cash, and long-term assets like buildings or equipment. And similarly, it shows short-term bills you need to pay soon versus long-term debts like bank loans. It really shows how big decisions like borrowing money for expansion or investing heavily in new equipment, how those directly affect a company's overall stability and its long-term health.
Okay, so income statement for performance over time, balance sheet for a snapshot of health. And then we come to what our source rightly calls the lifeblood of a business, the cash flow statement.
Yes, maybe the most intuitive in some ways.
This is where the rubber truly meets the road. Because here's a really powerful insight, one that might surprise you. Companies can actually show really strong profits on their income statement.
Looking great on paper.
Exactly. Looking healthy on paper, but still fail miserably because of poor cash management.
It happens.
It's like having this thriving garden, that's your profit, but you don't have enough water, the cash, to actually keep it alive.
Good way to put it.
So the cash flow statement, it breaks down exactly where cash is coming from and where it's going. And it categorizes it into three main areas. First, you have operating activities. That's the cash generated or used by your core business operations. Sales coming in, paying suppliers, paying salaries.
The day-to-day stuff.
Right. Second, there's investing activities. This involves buying or selling long-term assets like equipment, land, maybe even investing in other companies. And finally, financing activities. This covers things like taking out loans, issuing new shares of stock, or paying dividends back to shareholders.
So borrowing, equity payout.
Exactly. And for you, the manager, this means you absolutely must understand how your daily actions managing inventory levels, how quickly you collect payments from customers, how that directly impacts the actual tangible cash flowing through the business.
Indeed. And this distinction, the one between profit and cash, it's a central theme from our source, and it's just crucial for any intelligent manager. The powerful truth is, as the source states it, profit is an opinion, cash is a fact.
Profit is an opinion, cash is a fact. Say more about that.
Well, think about it. Accounting rules, as we mentioned, with accruals and depreciation, they offer a degree of flexibility of judgment.
Okay.
They can shift reported profits based on various interpretations and choices, how quickly you recognize revenue, how you value your inventory, how you depreciate an asset. Now, these are legitimate choices within the accounting rules, but they are still opinions about how best to represent the economic reality.
Great interpretations.
But the cash sitting in the bank, or maybe the lack of cash, that's undeniable, it's concrete, it's real. So intelligent managers, they understand this fundamental difference, and they make it a point to diligently track both profit and cash flow.
Okay, so what does this really mean for you listening? Are you focusing enough on actual cash flow within your department or maybe your project? Or are you primarily looking at those reported profits? Because if profit is an opinion, you can imagine it like maybe a carefully crafted highlight reel of your project's performance. It looks great, full of potential strong numbers shown in the best light. Cash, on the other hand, is more like the raw, unedited footage.
Yeah.
It shows every bump, every delay in payment, every moment where the money actually moved, in or out. You absolutely need both perspectives to get the full, honest picture and, importantly, avoid a sudden, unpleasant surprise down the line.
That's a great analogy.
The highlight reel versus the raw footage.
Now, to take all this raw financial data we've been talking about and turn it into genuinely meaningful insights, we need some tools, right?
Right. You need ways to analyze it.
And that's where financial ratios and metrics come in. Our source presents these as your essential diagnostic toolkit. They let you quickly understand what the numbers are really trying to tell us. We can look at categories like liquidity ratios. These are basically asking, does the company have enough quick cash available to cover its immediate bills? Things due in the next month or two.
Crucial for short-term survival.
Absolutely. Crucial for knowing if you can fund unexpected project needs or if you might hit a cash crunch. Then there are profitability ratios. These tell us if we're generating enough return on our efforts. Basically, are we getting a good bang for our buck?
How effective are we?
Yeah. Then, leverage ratios, which indicate how much debt the company carries. Too much debt can obviously be risky. And finally, efficiency ratios. These measure how well we're using our assets like inventory or equipment to generate sales or output. For example, if your efficiency ratio on a new process suddenly drops, that's a direct signal for you, the manager, that maybe your resources aren't translating into output as expected. It demands immediate investigation.
Exactly. But what's truly fascinating here, and a key point from the source, is that ratios are incredibly powerful tools, but their meaning depends entirely on context.
Oh, context.
Always context. Just looking at a number in isolation, say a profit margin of 10%, is rarely helpful on its own. Is that good, bad, average?
You don't know without comparing it.
Precisely. It's like reading a single word without the rest of the sentence. You need to consider the industry you're in. Margins vary wildly between, say, software and grocery stores. You need to think about the size and growth stage of your company. A fast-growing startup might have low profits but high investment, totally different profile to a mature company.
And overall economic trends matter too, right?
Absolutely. A liquidity ratio that might be perfectly healthy for that tech startup could signal deep trouble for a mature manufacturer, or vice versa. So this leads us to a crucial realization. When you're looking at these metrics, what comparisons should you be making to truly understand their significance?
Good question.
Are you looking at your own past performance, tracking trends? Are you comparing against industry benchmarks? Or maybe looking directly at your competitors' data? That comparison is where the true insight really lies.
Okay, so ratios are tools, powerful ones, but context is everything.
Exactly. And this brings us beautifully to what our source calls the human side of finance, which is just critically important to remember. Remember, accounting isn't just cold, hard math, as we've discussed. It inherently involves judgment calls.
Right, the choices.
What gets counted, when it gets counted, how it gets valued. This is precisely why managers need, well, a healthy dose of skepticism.
Skepticism, okay. Not cynicism, but skepticism.
That's a great distinction. Healthy skepticism. The numbers by themselves don't always tell the full story, but they absolutely reveal patterns and potential red flags that should prompt you to ask more questions. For example, maybe your quarterly results look fantastic, profit is up, but you, as the manager close to operations, know your sales team is offering unusually long payment terms, just close deals at quarter end.
Pulling sales forward artificially.
Or maybe inventory write-offs for obsolete stock are being delayed to make the current period look better. That's where your managerial skepticism needs to kick in. The numbers might tell one story on the surface.
But your operational intelligence, knowing what's really happening, reveals another layer.
Exactly.
That's a really vital distinction. So it's not about trying to become an accountant yourself. It's more about becoming a more astute question asker.
Precisely.
So you, the financially intelligent manager, you should be asking things like, what story do these numbers really tell about our operations on the ground? Or what crucial information might be missing from this financial picture? And maybe most importantly, how do my decisions, the ones I make every single day, impact these numbers and the overall financial health of our team or our organization? The ultimate goal isn't just to stare at spreadsheets in isolation. It's to proactively connect that financial data to the broader business strategy and ultimately to the people who are driving that strategy. What a difference that makes to your ability to actually lead effectively.
It really does.
And that brings us towards the end of another deep dive. What we've explored today from financial intelligence for managers, beyond the numbers, is, I think, truly transformative for anyone looking to step up their leadership game. Just to quickly recap those core takeaways we pulled out. First, you absolutely do not have to be an accountant to understand finance. Learn the basics and use them as powerful decision-making tools.
Get comfortable with the fundamentals.
Second, always remember that financial statements aren't perfect, unadulterated truth. They are interpretations, shaped by accounting rules and professional judgments.
The opinion part we talked about.
Exactly. Third, cash is king. Always, always track actual cash flow alongside those reported profits because they tell different, equally important stories.
Can't stress that enough.
And finally, remember, ratios and metrics only truly matter with context. Always compare across time, across your industry, and against your own strategic goals to get the full picture. Ultimately, financial intelligence really is about combining the numbers with context, with that healthy skepticism and a clear understanding of their impact.
Wonderfully summarized. It's really about equipping you to see beyond just the surface numbers, isn't it?
Yeah.
To ask better, more incisive questions, and ultimately, yes, to make smarter, more informed business decisions. So as you reflect on this deep dive, maybe consider this question. How might understanding the judgments and the choices that sit behind the numbers, how might that shift your approach the next time you're in a strategic discussion? And what new insights might you uncover about your organization's true performance, insights you might have missed before you started thinking this way?
That's a great thought to leave people with.
There's always more to learn, of course. And engaging with these multiple perspectives, looking at the numbers, the context, the human element, it will undoubtedly enrich your understanding and really enhance your leadership influence.